Roth IRA or traditional IRA, which one is actually right for you? If you've been stuck going back and forth on this question, you are definitely not alone, because this is one of the most searched retirement questions on the entire internet. The reason it feels so confusing is that almost every answer online ends with the same useless phrase, "it depends," which is technically accurate but completely worthless when you're sitting at your laptop trying to actually pick an account and click the button. Here's what I'm going to do over the next 20 minutes. I'll walk you through what an IRA actually is, exactly how each version works under the hood, and then I'll give you a concrete decision framework built around real scenarios, including a 25-year-old earning $45,000 a year and a 40-year-old earning $120,000. By the end of this video, you'll know which one probably fits your situation. We'll also cover the backdoor Roth strategy for high earners, and I'll show you how an IRA fits alongside a 401k. Let's get into it. Let's start with the basics. IRA stands for Individual Retirement Arrangement, though most people just call it an individual retirement account, and the key word there is individual. This is something you open on your own at a brokerage like Fidelity, Vanguard, Schwab, or Robin, completely separate from anything your employer offers. You don't need a fancy benefits package, you just need earned income, meaning wages, salary, tips, or self-employment income, and you can open one in roughly 10 minutes online. IRAs trace back to 1974 when President Gerald Ford signed a law called ERISA on Labor Day of that year, and the original contribution limit was a modest $1,500. Today, the limits are much higher, and there are two main flavors you need to understand: traditional and Roth. The Roth version came along much later, created in 1997, and named after Senator William Roth of Delaware, who pushed the legislation through. Here's the mental model I want you to hold on to. Both types of IRAs are really just containers that hold your investments, whether those investments are index funds, ETFs, or target date funds. The account itself is not the investment, it's the wrapper that gives you tax advantages. And the difference between traditional and Roth comes down to exactly one question: when do you want to pay the taxes, now or later? Let's start with traditional. A traditional IRA lets you contribute pre-tax money, which in plain English means you can usually deduct your contribution from your taxable income that same year. If you happen to sit in the 22% tax bracket and you put $7,000 in, roughly $1,540 disappears from your tax bill, and that's the upfront reward for choosing traditional. From that point forward, your money grows tax-deferred, which means every dollar of dividends, interest, and capital gains compounds year after year without getting nibbled at by taxes. No 1099 arrives in your mailbox every spring, and the IRS leaves your account completely alone while it grows. But the IRS always gets its cut eventually, and this is the important part to understand. When you retire and start pulling the money out, every dollar you withdraw gets taxed as ordinary income, contributions, and growth alike. You deferred the tax bill, you didn't erase it. A few other rules matter here. If you pull money out before age 59 and a half, you generally owe a 10% early withdrawal penalty on top of the regular income tax, though there are exceptions worth knowing about. Those exceptions include a first-time home purchase up to $10,000, qualified higher education expenses, certain medical expenses, disability, plus a handful of newer ones added by recent legislation, including up to $22,000 for federally declared disasters and up to $1,000 a year for emergency personal expenses. The default rule stays the same, though, which is that if you touch the money early, you pay the penalty. The second rule involves required minimum distributions, usually abbreviated as RMDs, because the IRS refuses to let you leave the money in there forever. Under current law, thanks to the Secure Act 2.0 passed at the end of 2022, you have to start taking withdrawals at age 73. And if you were born in 1960 or later, that age shifts up to 75 starting in 2033. The IRS calculates the minimum based on your account balance and life expectancy, and if you miss it, the penalty used to be a brutal 50% of the shortfall. Secure 2.0 dropped that penalty to 25%, or 10% if you fix it quickly, but it remains a penalty you absolutely want to avoid. The third rule matters a lot for your decision, which is that your ability to actually deduct your traditional IRA contribution depends on your income when you're also covered by a workplace retirement plan. We'll come back to those exact numbers in a minute. Traditional in a nutshell looks like this: tax break now, tax bill later, forced withdrawals starting at 73. Now let's flip the whole thing around. A Roth IRA is the opposite deal, and you contribute money you've already paid taxes on, which means no upfront deduction and no tax break this year. The $7,000 you put in comes straight out of your already taxed paycheck with no rebate from the IRS. What you get in exchange is genuinely powerful. Your money grows completely tax-free, and when you pull it out in retirement, assuming you follow the rules, every single dollar comes out tax-free. Contributions, growth, decades of compounding, all of it, zero tax owed on any. The Roth has some additional features that make it remarkably flexible. There are no required minimum distributions during your lifetime, and the IRS literally says in its own documentation that you can leave the money in a Roth IRA as long as you live. That's a huge deal for estate planning because you can let it compound untouched into your 80s and 90s and then hand the whole account to your kids. Here's a feature almost nobody talks about. You can pull your contributions out at any time for any reason with zero taxes and zero penalties. And I want to be specific here. We're talking about the contributions themselves, not the earnings. Say you contribute $7,000 a year for 5 years straight, which means you've personally put $35,000 of your own money into the account. You can pull that $35,000 back out whenever you want. The Roth IRA ends up being a strange hybrid, part retirement account and part emergency backstop. And while I'm not suggesting you should treat it that way, it's a safety net that traditional IRAs simply do not offer. The earnings follow different rules, though. Pulling earnings out tax-free requires you to satisfy what's called the 5-year rule, and you also have to be at least 59.5 or disabled or using up to $10,000 toward a first-time home purchase. That 5-year clock starts January 1st of the year you made your first Roth contribution to any Roth IRA anywhere. If you opened your first Roth in April of 2026 and labeled it for tax year 2025, the clock actually started back on January 1st of 2025. Roth, in a nutshell, looks like this. No tax break now, tax-free withdrawals later, no forced withdrawals ever, and dramatically more flexibility than traditional. Now let's get into the actual numbers, which the IRS sets and which tend to change most years. So I'll give you both 2025 and 20 so you can match whichever tax year you're dealing with. For 2025, you can contribute up to $7,000 a year to an IRA, combined across traditional and Roth. And if you're 50 or older, you get an extra $1,000 catch-up contribution that brings you up to $8,000. For 2026, the standard limit moves to $7,500, and the catch-up contribution rises to $1,100, putting the total for older savers at $8,600. That catch-up number finally went up because Secure 2.0 indexed it to inflation for the first time. Income limits are where these two accounts really diverge from each other. Roth IRAs come with a direct income cap, meaning if you earn too much, you simply cannot contribute directly. For 2026, a single filer can contribute the full amount up to $153,000 of modified adjusted gross income, with the contribution getting reduced between $153,000 and $168,000 and disappearing completely above $168,000. Married filing jointly in 2026, the full contribution phases out between $242,000 and $252,000. Traditional IRAs work very differently on this front. There is no income limit on contributing at all, and anyone with earned income can put money in. If you or your spouse is covered by a workplace retirement plan like a 401k, your ability to deduct that contribution phases out at certain income levels. For 2026, a single filer covered by a workplace plan sees the deduction phase out between $81,000 and $91,000, while married filing jointly with the contributor covered runs between $129,000 and $149,000. Above those thresholds, you can still contribute, you just cannot deduct it, and that creates the specific scenario we'll revisit when we get to the Backdoor Roth. One more detail: if neither you nor your spouse is covered by any workplace retirement plan, your traditional IRA contribution is fully deductible no matter how much you earn. Here's the core decision frame. The Roth versus traditional question really comes down to a single question, which is whether you think your tax rate will be higher now or higher in retirement. If your tax rate will be higher in retirement, a Roth is the right move because you pay the tax today at a lower rate, lock it in permanently, and never owe tax on that money again. If your tax rate will be lower in retirement, traditional wins because you skip the tax at today's high rate and pay it later at a lower. Here's the part almost nobody bothers to point out. If your tax rate ends up being exactly the same in retirement as it is today, the two accounts produce mathematically identical results, and Fidelity confirms this directly in their own published materials. The math is completely symmetric. It's just the order of operations of multiplication. The real question, then, becomes which direction you think you're headed. A few things usually tip people one way or the other. Younger workers early in their careers are typically in lower brackets than they will be later in life, which means Roth makes sense because you're locking in a low rate today. Mid-career professionals in peak earning years might be in a higher bracket right now than they will ever be in retirement, and that's when traditional could save them more money over time. Here's the wrinkle. When you eventually have to take required minimum distributions out of a traditional IRA starting at age 73, those forced withdrawals can actually push you into a higher bracket than you ever expected to hit in retirement. Ed Slott, who the Wall Street Journal has called the best source for IRA advice, puts it blunt, saying that RMDs on a large traditional IRA can end up being, in his words, far in excess of what your W-2 was during your actual working years. On top of that, traditional IRA withdrawals count as income for Social Security taxation purposes, and they can make up to 85% of your Social Security benefits taxable. Roth withdrawals don't count toward that calculation at all, and that's a hidden cost of traditional most videos never bother to mention. Let's make this framework concrete with 4 real people. Scenario 1 involves Maya, who is 25 years old, working her first real job, earning $45,000 a year, which puts her in the 12% federal tax bracket. If she contributes $7,000 to a traditional IRA, she saves roughly $840 on her taxes this year, which is nice but not life-changing. Maya has 40 full years of compounding ahead of her. Her income is almost certainly going to climb over her career, and she'll probably land in a higher bracket later in life. The Bogleheads Wiki, which is a respected community built around Jack Bogle's investing philosophy, explicitly states that contributing to a Roth at 12% or less is usually a good idea because that's a historically low tax rate. For Maya, the answer is pretty clear, and that answer is Roth. Scenario 2 involves David, who is 40 years old, earning $120,000, married, filing jointly with a stay-at-home spouse, and covered by a 401k at work. David sits in the 22% federal bracket, pushing into 24 on the margin, and he expects his income to stay roughly flat until retirement, while his retirement income will likely drop, consisting mostly of Social Security plus whatever he's personally saved. For David, the traditional IRA deduction is worth more in absolute dollars, coming out to about $1,540 a year at the 22% rate, and he expects to pay a lower rate when he eventually pulls the money out. Traditional makes more sense for him, or at minimum, it's a legitimate choice. Here's the important part. Because David is covered by a workplace plan and earns $120,000 jointly, he remains within the deductible range for 2026. But if his joint income were above $149,000, he couldn't deduct a traditional contribution at all, and the math would swing right back toward Roth. Scenario 3 involves Sarah, who is 32 years old, earning $85,000 as a single filer, and also covered by a 401k at work. Sarah lives in the 22% bracket, and her income lands right at the edge of the traditional IRA deductibility phase-out for 2026, which runs from $81,000 to $91,000, meaning she can only partially deduct a traditional contribution. Once the upfront tax benefit gets watered down like that, the Roth's long-term tax-free growth becomes much more attractive by comparison, and for Sarah, Roth is almost certainly the better call. Scenario 4 involves Marcus, who is 45 and earning $200,000 a year as a single filer. Marcus sits above the Roth income limit for 2026, and he's also above the traditional deductibility limit because he has a 401k, which means a direct Roth contribution is off the table for him, while a traditional contribution wouldn't even give him a tax deduction. This is precisely the situation the Backdoor Roth was designed to solve, and we'll get to that in a minute. You can probably see the pattern now. Young with low to mid-income leans, Roth, mid-career with high income and a lower expected retirement bracket, leans traditional. Near the phase-out edges, Roth usually wins because traditional loses its tax break. And for very high earners, the answer becomes Backdoor Roth. Opening an IRA is genuinely one of the easier things you can do in personal finance. Pick a major brokerage like Fidelity, Vanguard, Schwab, Robinhood, Wealthfront, or Betterment. Head to their website, click open an IRA. Choose traditional or Roth, enter your information, link your bank account, and transfer money in. Most of these brokerages now offer zero account minimums and zero commissions on stocks and ETFs, and the whole process takes about 10 to 15 minutes from start to finish. Here's the part that trips people up constantly. Once you've funded the account, your money is just sitting there in cash, completely uninvested, because the IRA is only the container and not the investment itself. You still have to choose what to actually buy inside the account. For most beginners, the simplest answer is a low-cost total market index fund or a target date retirement fund. I'm not going to deep dive on index funds in this video because that's its own topic entirely, but understand that there's a second step involved. Open the account, fund the account, buy the investment, 3 distinct actions that all need to happen. Now for the bonus section, the Backdoor Roth IRA. This strategy exists for people like Marcus in scenario 4, meaning high earners who sit above the Roth income limit but still want tax-free retirement growth. Here's how it works mechanically. There is no income limit on contributing to a traditional IRA, only on deducting the contribution. So a high earner can make a non-deductible traditional IRA contribution and then immediately convert that traditional IRA into a Roth IRA. No income limit exists on Roth conversions either, because that cap got removed back in 2010, which means the strategy is completely legal. As of April 2026, it remains fully allowed, and the One Big Beautiful Bill Act signed on July 4th of 2025 did not touch backdoor Roths at all. Ed Slott's firm publicly confirmed that there is nothing in the new law specifically about Roth accounts. Here's the trap to watch out for, and it's called the pro rata rule. If you have any other pre-tax money sitting in a traditional IRA, SEP IRA, or a simple IRA anywhere, the IRS doesn't let you convert just the new non-deductible piece cleanly. They aggregate every one of your IRA balances and treat the conversion proportionally across all of them. To put numbers on it, if you have $93,000 sitting in a rollover traditional IRA from an old 401k and you add $7,500 in fresh non-deductible money and try to convert only the $7,500, most of that conversion ends up taxable anyway. The workaround involves rolling any existing pre-tax IRA balances into your current employer's 401k before December 31st of the year you do the conversion, which gets your total non-Roth IRA balance down to zero on that date and lets the backdoor Roth work cleanly. If you're in that situation, it's absolutely worth talking to a CPA before you pull the trigger on the conversion. One last quick topic, which is how an IRA fits alongside a 401k. The good news here is that you can contribute to both in the same year, and the contribution limits are completely separate from each other. So for 2026, you can put $7,500 into an IRA and $24,500 into a 401k without any overlap whatsoever. The order of operations that most financial planners recommend goes something like this. First, contribute to your 401k up to whatever your employer matches, because that's free money and there's no better return you'll ever get anywhere. Second, max out your IRA, choosing Roth or traditional based on the framework we just walked through. Third, go back to your 401k and contribute up to the annual maximum if you can afford to. That's the basic priority stack most planners use. I'm not going to deep dive on 401k mechanics here because that's a whole separate topic, but the main thing to know is that an IRA doesn't replace a 401k, they complement each other. Let me give you the simple version of the decision framework to close this out. If you're young, early in your career, sitting in a low tax bracket, and expecting your income to grow over time, you want Roth. If you're mid-career, in a higher bracket now than you expect to be in retirement, and covered by a workplace plan but still within the deductibility income range, you want traditional. If you're near or inside the traditional deductibility phase-out, meaning your contribution wouldn't be fully deductible anyway, you want Roth. And if you're above the Roth income limit as a high earner, you want the backdoor Roth approach we just walked through. Honestly, if you really cannot decide between them, split the difference and do some of both. Tax diversification is a completely legitimate strategy, and Vanguard and Fidelity both explicitly recommend it because nobody actually knows what future tax rates will look like decades from now. Here's the last thing I want you to hear, because it matters more than the Roth versus traditional debate itself. According to the Investment Company Institute, only about 44% of U.S. households owned any IRA at all as of mid-2024, meaning more than half of American households have zero retirement account of this type. The average Gen X IRA balance at Fidelity sits just under $104,000, while the average millennial balance comes in around $25,000. The biggest mistake is not picking the wrong IRA. The biggest mistake is not having one at all. Either choice, Roth or traditional, beats the alternative of doing nothing by an enormous margin. So if you've been stuck on this decision for weeks or months, just pick one and get started. You can open the other one later, you can do both, and you can split your contributions between them year to year based on how your situation evolves. This decision is not permanent. Open the account, fund it, invest it, and your 65-year-old self will thank you.